doing, friends? It is 0 days to expiration. This is season 2, episode number 55, and today we're going to make the big choice to Batman or not to Batman. To go the singular out of the money fly, or do you go with a more market agnostic fly? How do you make that decision? Which trade to play in our 0 DTE system? All right, so first of all, what is it that we do? We are a coaching and mentoring service where we teach traders how to become consistently profitable, independent, and trade at a professional level. But first, I must sneeze, and then we can get to the trading. All right. This is a coaching and mentoring service where traders learn how to trade this strategy. Now, the strategy isn't necessarily my own strategy, although parts of it are definitely what I've developed. The basic strategy is borrowed from what I've seen floor traders trade back in the day when they had floor traders. And they had a very simplistic way of getting into the trade, but it worked out well. It had good capital efficiency, risk to reward, was easy to manage from a profit standpoint. They could put on multiple trades a day. They played the vol game, played the time game, and it had very little drawdown. So when you're trading with big money, I mean, that's important, obviously. The way we've adapted to it is, well, a more complete profit management framework. But the profit management framework is very comprehensive. It takes into consideration the time of day that you're in, the position of the trade, the underlying market structure, the volatility, all kinds of things. And it's very compartmentalized and allows you to treat each day with its own specific logic. So that's all great. And when you become skilled at that, you can really create fantastic returns. Now, the one biggest question I think most people have, and the thing that kind of baffles new members, is how do you get into the trade? What is the process by which you get in? They are so steeped in this, how should I say it, this cultural or I guess, this industry-wide belief that the entry is the most important thing. And, it is important if you have an idea of what you're going to do once you enter it or why you're entering a trade. But in our trade, the entry is, the general entry is somewhat important. We get in the morning basically because we're looking for at least some volatility crush to aid in our strategy, but that's not the real basis behind the trade. The real basis behind the trade is putting on a capital efficient trade, one that has extreme risk to reward, and one that is properly priced, that has the right width and cost, so that it is in line with your personal capacity and tolerance for risk. Those are the important parts. Getting in, the exact timing, what's the underlying market structure, for the most part, doesn't matter. We can get into the trade sometime in the morning, somewhere between the open and 10:30, 11 o'clock, around there. Doesn't matter. As long as we put on a good risk to reward, a 1 to 9 or better, we're good to go. And in terms of the width, sometimes when we have a volatile market, we might go a little wider. When we have a less volatile market, like right now, we might go a little narrower. But other than that, there's not a big difference. You find a time that you can get in, and then you get in, and then you manage the trade. Now, there are two ways to take this trade. Now, it is a directional trade, or it can be a market agnostic trade. That's the basic difference between the out of the money butterfly, which is a directional trade. You can either have an out of the money call butterfly, and all of our butterflies that we put on, by the way, are long butterflies. We don't use the iron butterfly. There's really no need to add complexity to the trade. Now, one question I get a lot of is, well, geez, if you're not an iron butterfly, if it's not collecting premium, then how can you collect premium? Well, there's a big misnomer that just because you have an iron butterfly as opposed to a long butterfly, and one's a debit, one's a credit, doesn't mean that both of them don't collect premium. They do. They both have short strikes on them that actually are doing the premium collection. So this idea that it has to be a credit in order to collect premium is really just a fallacy. So we put on a long butterfly because it's easier, it's simpler, easier to manage. And we put it out of the money so that we can create a proper risk to reward. If we believe that the market's going up or we have a long bias, then we put it a call fly above the market. If we believe the market and we have a bearish bias, then we put on a put fly and put it below the market. If we don't really have any idea, which is most of the time, or at least half of the time, then we put one both above the market and below the market. Now, this one turns out to be, something that looks like Batman's ears, therefore we call it the Batman trade. Now, the big question is, when do you use which one? Out of the money call, out of the money put, or the Batman? That is the question. Well, here's an undeniable truth. It mostly doesn't matter. And you might think, man, that sounds really weird. Why wouldn't it ever matter? The reason why it doesn't matter is that the Batman and the out-of-the-money butterfly, if you were going to trade the Batman all the time versus just picking a direction with the out-of-the-money butterfly, either above or below the market, based on whatever you think is going to be right for that day, for the most part, you're going to be about a 50-50 trader either way. In fact, you might be a little bit higher in terms of your win rate with the single out-of-the-money butterfly because you might have a particularly good knack for choosing direction. But still, you're not going to be that right because even when you think you have the right direction, the market might end up going the other way. So it's going to end up probably, and this has been my experience, and I feel like I'm a pretty good judge of choosing direction. I've been anywhere from 55 to 60, maybe 65% correct if I choose direction and choose an out-of-the-money fly. Now, if you choose a Batman, it doesn't matter, right? You can be right or wrong. The only way you can be wrong with a Batman is if the market neither goes up or down and just stays right in the middle. And then you're wrong on both sides. So the Batman tends to have a slightly lower than 50-50 win rate, probably closer to 45%, 46%. In fact, my current win rate is about 46%. Now I do a combination of both Batman and out-of-the-money butterflies. So the reason for this is that let's take a look at what are the up-down statistics of any market. Now, I'm going by memory, but I've looked at this many times, and it's pretty much the same no matter what market you look at. But take any yearly market, a year or a quarter or a month or any span of time. And regardless of whether it's a bullish market or a bearish market or a sideways market, look at the number of days that are up days versus the number of days that are down days. Even in a bull market, your up days and down days are going to be approximately 50-50. You might have a slight edge on the high side, maybe 52-48. And for all the down days, it's the same deal, 50-50, maybe 52-48 on the down days. But that's not a given. I mean, you could literally have more down days than up days on a bear market. The difference that would make it a bear market is that the down days tend to outstrip in terms of magnitude of the move compared to the up days, and vice versa for the bullish market. On a sideways market, it's anybody's game. It could, again, 50-50. In general, if you take all of the trades over the course of a year, you'll find that it is approximately 50 going up, 50 going down, right? Now, that doesn't say anything about the magnitude of the move. That magnitude of the move will vary. On average, it might be somewhere between 0.8 and 1.2% of the total market value. So that's and then every once in a while you get a 1.5% move or a 2% or even a 3%. Those larger moves are more like outliers. So the vast majority of your moves are going to be between 0.5 and 1.25%, something like that. So and whether they go up or down, it's anybody's game. So think about that. If you're going to put on any kind of trade, whether it's a bullish or a bearish trade, and in this particular case, we're looking for both a move as well as premium collection. So it's a combination of the two. They work off of each other. If we can get a move going far enough and it gets inside of our profit tent, we also can enjoy the premium collection that can explode the amount of profit that we make. Now, most of our strategies, most of our positions are small moves, and they may not even get inside the profit tent. So the vast majority of our trades are going to be offsetting trades. You're going to have an equal number of or capacity, losers as winners, and those trades will generally offset each other, and you'll be going sideways. Your profit curve will look like this, but very well contained. And then every once in a while, you make a bigger move. Now, if it's a bigger move going against you, you don't care because we've already capped our risk because we have a defined risk. But the upside isn't as well defined. It can be as much as 10 times or more than the risk that we take. So we're essentially allowing much larger moves to happen, but not allowing smaller moves or negative moves to happen. We limit the negative moves. And because of that provides us with this positive expectancy and also this low drawdown because we can control our risk, etc. So it's still, I haven't answered the fundamental question. When do I put the Batman on? When do I put the long or the short or the bullish or the bearish out of the money fly? Well, here's what I do. And this might sound a little crazy, but if I'm from a very big picture point of view, I'm going to develop some kind of market bias. I'm going to be either wildly bullish or moderately bullish or neutral or moderately bearish or wildly bearish. In the case of wildly bullish or wildly bearish, I'm probably going to put on the majority of my trades will be either a bullish out of the money call fly or a bearish out of the money put fly. But those are very rare cases where you just wildly bullish or bearish, right? Because how often does that really happen? And even there, I'll probably end up being about maybe 55, 60% right. It's maybe 65 at the outset. There have been some months where I've been as high as 95%, but those are outlier months. Long term, it probably ends up being around, if it's that type of market, a wildly bullish or bearish market, then I can probably hit around 60, maybe 65%. But that's good because I'll tell you, anything over 40% in this strategy makes fantastic money. So a 65% win rate in this strategy is just wildly successful. In fact, that's the way it was back in 2021, and I tripled an account within just 9 months. So you can see the power of this. Now, let's say that you're moderately bullish or moderately bearish. What do you do then? Well, the single out of the money fly probably isn't going to cut it as much. The probability of you developing streaks that could extend, in other words, having a winning streak or a losing streak, is a very real thing. I mean, after taking, say, 2, 3, 4, 500 trades, you can expect to have winning and losing streaks if your ability to choose the market is around 50-50 that are going to extend to 9 or 10 in a row. And so you have to figure out, well, man, I don't want to have 9 or 10 losers in a row. How am I going to control that? Well, the easiest way to control that is that because we take such small risk, we can adjust our overall position size so that even if it does move 9 or 10 moves in a row, bullish or bearish, let's say, the only case that we're really worried about is if it's a losing trade, then our risk is always super small. So if you're taking like a 1 to 12 risk to reward and say all of your ones are just $100, giving you, say, $1,200 of potential profit, then even if you lose 10 in a row, you're only talking about $1,000. And the odds of losing 10 in a row are relatively small, but, they are a statistical certainty over the course of, say, 300, 350 trades. That is a pretty good bet that you're going to have at least one streak up and down like that. So you plan for it, and so you trade that way. Now, still, I haven't answered how I choose, whether I'm going out of the money fly or a Batman. And this is going to really surprise you. But before I do, let me tell you why I developed the Batman and what the real difference is between trading with a single out of the money fly versus a Batman. The reason why I added the Batman, at first we just did out of the money flies. That's the way we rolled. And when we first started this service, there were only 3 weekly expirations. So if there are only 3 weekly expirations, and then over the course of, say, 200 trades, you could have, let's say, 7 or 8 losers in a row, you do the math. That means that you could go, literally, 2.5, maybe even 3 weeks, depending on when the losing streak started, 3 weeks of just losing. Now, from a time point of view, a length of time point of view, that seems arduous. But from an actual loss point of view, it's very manageable because my drawdowns, because of the small risk to reward, never really exceeded about 3.25–4% of my total capital. That is super small. That is super small. Right? A 4% drawdown? Are you kidding me? That is what you're after. You're after those tiny, tiny little drawdowns. That helps you stay in the game and keep your mind straight. Right? That's what you want. So even if I have this extended losing streak, it's not a big deal. I can keep it together. I don't go on tilt. Right? I'm composed. No problem. Just keep on doing what we're doing and keep your mind straight. Follow through with your process. Do the same thing over and over again, and then you're going to come out on top because it's all going to average out. You're going to still get that 50-50. Even if you go down to 40%, you're still winning. So, it's like, okay, big deal. So, but in the beginning, when you're bringing on new people, and this is one of the reasons why I have a 4-week trial, because 4 weeks will start giving you a better flavor for what's happening. Now, since that time, we've gone to 5 expirations per week. But back then, new people would come in and they say, we just had this awful streak and it's just driving me nuts. How do you handle this mentally? And it's one thing to handle 7 losers in a row, and even if they're small, but it's another to have 7 losers in a row that are over a large span of time. So I figured, okay, we can fix that problem by doubling up on our trades, making them more market agnostic. So you can put one above the market, one below the market. Let me ask you, if you like this content so far, this is a deep discussion on how you actually make money in the markets with little risk and with just a little bit of diligence, some persistence. Your persistence will pay, and then that consistency will compound. If you like this content, give this video a thumbs up right now. Take the time to go down and subscribe right now and turn on that notification bell, because we're going to be talking about deep discussions like this from now on. We always have, but give it a thumbs up. So, as I said, a streak like that over a period of time can be daunting to some people, regardless of the fact that it's just a small drawdown, because that's definitely manageable. It's definitely better than, say, drawing down 25 or 50%, right? So we're drawing down just small, but still that time is like I said, it's daunting. So what I did was I decided, okay, we're going to do a market agnostic trade. That's the reason why I created the Batman trade. So we'll put one above the market, one below the market. Now that changes the whole dynamics. And for that 3 expirations a week, that helped quite a bit, because now there was a much better chance that you weren't going to have, 7 losers in a row. That gets diminished dramatically. Now your win rate still stays around 50%. And the reason for that is that there is a distance in between the trades, between the 2 flies, that price could just stay there. Premium will decay. And I'll demonstrate that in a second, where it's just a losing trade, because there are some days where the market just doesn't move, right? Today is a very clear example of something like that. If those 2 trades are far enough apart and never reaches one or the other trade, then you're going to end up with a loss. So it's not either it's not a binary. Either you win here or you win there. It just doesn't work that way. There's still a good portion of trades in the middle that don't win. Plus, you have to take into account your fallibility as a trader. Even the best traders are fallible, and you don't win every trade. So the Batman at least solves that streak problem, right? But it introduces, there's a caveat to that. There's always a caveat. Whenever you try to fix a problem, it's like whack-a-mole. You whack this one and another one comes up. You whack that one and another one comes up over here. Well, the Batman's no different. And it has its benefits. One is you've solved the streak problem. You've also created a better distribution of returns, or what would appear to be a potentially better distribution of returns, because now you're going to have more potential pinned trades. Those are trades that get right inside the profit tent that make a lot of money. That will create another distribution that will not just be a long tail, but a long fat tail on your distribution curve. And I'll show you that in a second too. So those are really good things, right? But the real big problem, though, is that when you let's say that this is a butterfly, and then this is my debit, right? See, it's this thick. I got a big fat thumb here. And then this is my butterfly. So that debit right there, say, is $100 to maybe $1,000 for the potential profit. Now, let's say I have 2 of these. Well, they don't just go like this. You have to add the debits. Now you have twice the debit. You see the problem? Now, twice the debit, but still the same, a little bit less total profit. Your risk to reward is completely different now. It's almost cut in half. So you need to do some mathematical gymnastics there and start resorting to some more risk management. Now, let me just be honest with you. When we put a trade on like this, I don't manage that risk. I don't manage that one. But when I get like this, I do want to manage that. I want to get out of that trade if I get down to 50% loss. So that's an extra step that we have to do in this trade. It's a little extra. But darn it, I still have not answered when we put the Batman on and when we put the out of the money fly. All right. Are you ready for this? All right. Come up close. I'm going to tell you. I flip a coin. I flip a coin. I do. I flip a coin. Because it doesn't matter. For the most part, it doesn't matter. Now, if I have a wildly bullish market, yes, I am going to put that call fly on, and I'm not going to, put the put fly on. I'm going to put the call fly on. If it's a wildly bearish market, I'm going to put the put fly on. Yeah, but those are outliers. They don't happen that often. If it's a mediocre market, either bullish or bearish, I'm going to flip a coin. Half of them are going to be Batmans, half of them are going to be calls. If it's a bearish market, half of them are going to be Batmans, half of them are going to be puts. I don't know when is the best time to do one or the other, a out of the money fly or a Batman. I just don't. There's really no way to know. Consider what I had said earlier, that the market on a day-to-day basis, it's kind of a coin flip in of itself, whether it goes bullish or bearish, regardless of whether you're in a bull market or a bear market. So it really doesn't make a difference. So I flip a coin. There's if you go and do virtual coin flip or a coin flip app, there's a ton of them on the web. Just do a Google search, get your favorite app, push it, it'll tell you what to do. And there's some really cool ones. You can get them on your iPhone. You can get apps, an iPhone. I think I have one. Let's see. We'll find one here. Here, I'll do it with the, hey, this is a good time to go to the iPad. All right. I think I have to mirror this. Hold on. That's good. All right. So let's I don't know. We probably have apps in here, right? Let's choose an app. Let's choose the coin flip. There's got to be tons of them. Oh, look at this. You can get this guy here. There's another one here as well that I think that we should download too, because I can see some real benefit in using the Tiny Decisions app. But the coin flip app will certainly work for most things, right? So we'll just flip the coin and we'll say heads we go Batman, head, and tails we go tails we go out of the money fly. How about this time? All right, there you go. Is it going to go 50-50 every time, or am I going to get any streaks? Yeah, there's a streak. All right, 2 Batmans in a row. Fantastic. All right. So let's go back to the other one. Oh, the Tiny Decisions one. The reason why this one looked kind of interesting is that it looks like I can put numbers, a various number of levels of different items, right? So this reset wheel, how do we do this? There must be a settings or something. Wow, all this stuff that you can do. Oh, here we go. All right, so I can choose the number of items that I want. Let's say that I want to have a OTM fly, but I want an OTM fly like, I don't know, a certain percentage of the time.
Okay, I found this on the web for a certain percentage of the time.
No thanks,
Check it
Siri.
out.
And then the rest of the time I want a Batman. And we'll do one more, and then we'll get rid of the other one. So we have 3 Batmans and then 2 OTM flies. You see the difference here? Now, if I get rid of that one, right? So now I have 3 to 2, so I can change my odds. Apparently, let's see, how do you get rid of that? Oh, there it is. If you want to get rid of ads, I guess you have to purchase this. All right, so let's spin it now. See, OTM fly. Batman. Now, it should come up Batman more often than OTM fly. All right? So there you go. There's your decision wheel. Wow, 3 Batmans in a row. Oh man. I think we're stuck on Batman. Nope, there's OTM fly. So there you go. There's a great way to do it. That way you can set up the odds even and decide which way you want to go. You want to do a Batman, you want to do an OTM fly, and you could change the odds based on your degree of bullishness or bearishness. You could do the same thing with like an OTM fly. You could say an OTM call fly and an OTM put fly, and create all kinds of different things, and then just choose the one that you think is going to that you want to use. Then, let's say that you have a wildly bullish market, and then all of a sudden there's a pullback, and you're not sure if it's just going to be a pullback or the market's actually reversing. So you're kind of up in the air. You still think things are bullish, so maybe you put in 3 OTM call flies, maybe 1 put fly, and 5 Batman flies in your mix, and then you press the button and then see what happens. And so in the course of over dozens and dozens of trades, you're going to have a nice mix in there that will more or less accommodate your view of the market. So yeah, that's exactly how I've done it. How I choose which way that I'm going to go. I'm not as arrogant to think. And I used to be arrogant. In a way, sometimes I am, I guess, still. But I used to think that I was smarter than the market. And that used to get me into trouble. Big trouble. I'm sure you've felt like you look at the market and you say, it's never done that before. Of course, those words come out of our mouths on a consistent basis. So that says something. Do you want to be right or do you want to make money? So you need to capitulate to that you really don't know which way the market's going to go. And it doesn't matter. If you play a proper strategy like this, then it really doesn't matter which way the market goes. You can win either way. All right. So I think we have a few questions here. Hey, look, if you have questions, put them into the chat. I'd be happy to answer them. All right, Charles says, with Batman and OTM Butterfly being able to increase win percentage just 4 or 5% long-term over hundreds of instances is actually pretty significant. Yeah. Well, see, in the course of a year, I'll have anywhere from 350 trades to 450 trades. So over that period of time, yes, it does make a big difference. And you want the consistency too. The other thing is that you don't want to be consistently wrong. And sometimes, like I said, sometimes we want to be right. And as much as we want to be right, some of us just have a knack. It's sort of like the Jim Cramer knack of choosing the wrong stock. It's the you picking the wrong direction consistently. And some people feel like they're in that kind of funk, and it can happen, and it's a real thing. This is the easy way to take the blame off yourself and put it on the spinning wheel. All right, maybe a filter like SPX expected move. No, expected move does not work. For the 0 DTE above 30, go with the OTM fly under 30. No, it doesn't. No, it doesn't. Expected move is not going to tell you what the pricing of your strategy should be. When you put on a trade that has a certain risk to reward and you place it where the market says it has to go. So in other words, in order to put on, say, a 20 wide fly, and you want to put it on so that it has a debit of $2, means that you have to push it out far enough until it gives you that $2 or less. The market is telling you what the strikes are going to be for that cost and that width. The market is pricing it. An expected move will not give you that information. It just definitely will not. An expected move is not giving you, the market's value is not based on expected move. It's the other way around. Expected move is calculated based on what the market is valuing, right? So either you go with what the market says or you go with a derivative of what the market says. It's as simple as that. Can you ask Siri to flip a coin? I probably can. Hey Siri, flip a coin for me. You didn't hear it, but I have one of those Apple pods over there, and it picked it up. It flipped a coin. It said, "Oops!" It rolled onto the bed. That's funny. Charles says maybe rolling 10-day point of control if above price call. No, see, you're trying to think too much, Charles. This is what I was trying to say before. You're trying to be right. You want to be right. And I'm telling you, the more you try to be right, the more you're going to be wrong. And you're going to be questioning it. Like, how the hell could I be wrong so often? It's not you. The market just doesn't like you, doesn't want to give you what you want. So basically take what the market is willing to give you. All right, Chris, how about putting on a Batman for next day, 1 DTE? That's a viable strategy. As a matter of fact, that was my strategy. Well, we didn't use the Batman in the very first year, but we did the 1 DTE, and it wasn't even a 1 DTE. But I'll tell you some of the reasons why I don't want to do a true mosquito in here, a true 1 DTE. And probably the easiest way to do that is to show you on a with the iPad. All right, and this will be kind of illustrative. So we'll go to Procreate, and we will. I'm sure that there's. Okay, yeah. Let's just create it right here. So what I'm going to do is I'm going to draw what premium decay will look like over the course of a week, because these are weekly options. There are 8 days of them until we get to the 0 DTE. So if I divided this up into the week, 2, 3, 4, 5, 6, 7, 8. So this is the 0 DTE right there. And then this is the start of the premium decay. And then we'll we'll make blue the premium decay. The premium starts way up here, right? And then it's slowly degrading until it gets here and it goes like this, right? Now, that wasn't really drawn to scale, but if we were to do this properly, you would find that the premium decay that happens here versus here, this amount versus this amount, this total amount will be probably about 50 to maybe 55 to 65%. I know that's horrible, Ernie. Let's say 65% of all the total premium that's in here is going to decay in the 1 DTE and the 0 DTE. But about 50% of it is going to decay right there, maybe 45. So the vast majority of decay is going to happen in that last day. And so what that's saying is you're getting a much more efficient trade. You're getting more premium decay for the same period of time. Plus, you don't have to deal with the overnight risk, the Asian Open, the European Open, then the European close, and the American Open. you have far less things to really deal with if you go just with the 0 DTE. And that's the reason why the 1 DTE is not quite as attractive. However, there are some cases where you can play the 1 DTE where you're not really intending to bring it all the way through to the end of the 0 DTE day. Maybe you will take it off just before the open or just right after the open. And that's often a good strategy because when you put, say, a futures trade on at, say, 9 or 9:30 the previous night, you might get some significant movement in the market when the European Open happens at 3 a.m. or around 6 a.m. when everyone's waking up, 7 a.m. when a lot of American traders are starting to come online. Then there's the economic reports that usually come out around 8:30. So there might be a significant amount of price movement and even volatility change between the night before and before the market opens to make that 1 DTE a viable strategy. But in terms of the total premium that you have to potentially collect, and remember, it's not just premium that we're using to enhance this trade. That will give us an additional edge for sure, that premium decay. But what is also happening here is the price movement. That's important too. That's at least 60 to 65% of the trade. The rest of it is that premium decay. Of course, when we start getting later in the day of the 0 DTE, then the premium decay starts coming way, way into play then. So it can be a huge boost, but it really requires that price pushes us into our profit tent. So let me demonstrate that. So when we put on a trade, this is going to be a risk graph. And let's say we're here at the money, and we are going to put on a single out of the money fly. Like that. And it has a nice risk to reward, maybe a 1 to a 10 or something like that. Right? Our real-time profit curve when we get into that trade is going to look like this. So we're hoping that on this day, that when that market opens and we put that trade on, that price is going to go this way. But we know that there law of probabilities are coming into play, because some days it will only go this far, some days it will go this far, some days it'll go this far, some days it'll go this far, and some days it'll go this far. These days here, and that distribution is going, if I were to graph it, would probably look like this, right? Where these days would be more, and then as we go further out, the chances of it going that far would diminish. Right? I mean, that's just probabilities. So the vast majority of our profits are going to be in this area. And then, of course, we have our losses if price goes this way. So we have to manage our profits as price is going this way. It's both a positional, how far price is going, and a time thing. So it's both where and when we are throughout that day. We have to manage that profit, and we have to take it within consideration that knowing how often we're going to get each type of trade. Now, in a Batman, it's a different story. With a Batman, it looks more like the following. We're sitting here at the money, and we're going to put on 2 trades. Something like that. And then our profit curve, when we first get in, is going to look like this. And over time, it's going to start looking like this. Where it's going to be going down here, but up here and up here. So again, when we start right here, and whether we're going to go this way or this way, there is still a probability of where we're going to go, right? And that probability is going to look like a bell curve. Small probability that it gets out to here or out to here, and a much bigger probability that it stays in here. And that's the simple reality of this trade. Now, when we have a single fly on, we don't care if it goes one way because no matter how much it moves away from our strategy, it's always a fixed risk. All we care about is when it goes towards us. But when we have the Batman on, we now have the opportunity to make profit in both directions, but we also have this increased risk that we have here that is double the size of a single out-of-the-money fly, and that's what we have to deal with. So both of them are great trades. Let me show you what the price distribution looks like on our trades. We have what's called a right-skewed long-tail distribution. Oop. I'm sure you've seen the bell curve. The bell curve, as I just drew, looks like this. That's an even distribution. That's not what we do. What we do is we limit our losses so that they're never, say, more than this. And it looks like this. So these are our losses. These are our wins. Maybe I should put the wins in green, right? And then the losses in red. And what ends up happening is that, use orange here, this amount of losses will equal about this amount of wins. But all of this is pure advancement of your strategy, of your capital. And these are big wins. So that's now the Batman, what it does is it fixes a couple of problems. One is it makes the total number of small wins and small losses smaller by kind of cutting it off. I'll show you what a Batman curve looks like. I'll make it yellow. A Batman curve kind of looks like this, but it's got a fatter tail. So it's got a diminished amount of small wins and small losses, but it has more big wins, gold, like that. It is also right skewed, long tail, but with a fat tail. So that's great. That's fantastic. I guess the other difference is that the losses come out a little bit higher than like that, just a little bit more, but not as many. So that's the difference between our out-of-the-money fly and our Batman in terms of the long term, what it looks like. So there's a very complete explanation of the difference between the Batman and the out-of-the-money fly. They're both great trades. I'm not really a fan of having to manage our risk a little bit more with the Batman, where I don't have to manage our risk at all with the out-of-the-money fly. I just let it go, 100% loss. And in fact, I can show you exactly what this looks like by showing you my actual trade log. And let me do that because I plot it. So there you go. There's my actual trade log distribution of returns. Oop, get this guy out of the way. So you can see this small number of losses and wins, and then the long tails. Big wins. All right, but never a big loss. And then that looks like that when it's as an equity curve. And the red one here, that's our drawdowns. Our drawdowns are never big. So that's the result of our 0 DTE strategy. That is showing a more than about 100% return over a year. This particular chart is covering 422 days, but we were right here, right there on day 364. All right, and so now we're continuing the winning ways. All right, so hopefully that has been educational. And why we choose, go back to the big head, why we choose and when we choose a Batman over the single out of the money butterfly. Both of them are fantastic, but just a little bit different. I would say that the mix of the Batman and the out of the money fly complement one another, and that you can optimize your overall returns by mixing in the Batman along with the out of the money fly during less than certain market directional times. The other thing is that it looks like high volatility times or low volatility times don't really come into play here. The only thing that a high volatility regime or a low volatility regime might affect our trading is in how much risk that we can take. In fact, because our strategy is anti-fragile, and what does that mean? Anti-fragile means systems that gain from disorder. In other words, the more disorder, the more abruptness, the more pain thrown at a system, the stronger it gets. And that's exactly what our strategy is like. So the more volatility that comes into it, the stronger our strategy gets, allowing us to create much wider flies with much greater potential and push them further out for the same kind of risk without even taking any more risk. You can create these much greater potential trades without taking any more risk during high volatility times and potentially make much more money. So that's what happens in high volatility. When it's low volatility, everything kind of shrinks down a little bit. Still makes good money, but the potential is just, capped a little bit. So there you go. That's the nature of the way we trade 0 DTE. Look, if you like this content, give it a thumbs up, right? I mean, this is gold, man. And if you want to try it out, go down below. You'll see the link for a 4-week trial. It's a coaching and mentoring service. I've been in this industry for 40 years. I've been a institutional trader, a hedge fund manager, currently the CIO of a 9-figure family office fund. I've traded hundreds of millions of dollars in my career at once. I was a profitable trader. I've also been on the technology side. During the dot-com era, I was chief architect for Sun Microsystems Professional Services. My team literally built Wall Street. I know Wall Street both from the innards, from the guts, and from the outside, and as a professional trader. I've trained and coached hundreds, well, maybe even thousands of traders and been the trusted advisor to C-level folk from Fortune 5s. In fact, once I actually wrote a program directly for, I won't talk about that. Well, I will. It's Jack Welch at GE. I was, top gun in this organization and helping the technology C-level folk make their technology decisions in the financial world. I've got a tremendous amount of experience, and I can share it with you. I can show you how to become a peak performer. So just get down below there, click the button, join our service. You won't regret it. It will be, I guarantee you, it will be the best money you've ever spent in your trading career. We do everything very different from other retail traders because I'm showing you actually how to become a professional trader. If you want that for yourself, you want to develop the skill that you'll have for the rest of your life, join this service. No, I'm sorry. I don't know Oliver Valles. Hello from Belgium. How you doing? Would have to be XSP or SPX for best results. No. You can use, we do use XSP and SPX. We also trade the NDX. Actually, my biggest trades have been with the NDX. You could also use the RUT. You could use even the gold index. I think you could probably even trade treasuries, treasury futures. That would be kind of interesting. And also futures, E-mini futures, E-mini S&P futures. We trade those as well. So there's a wide range of things. And I also apply this strategy to stocks as well. I do this with Apple and Tesla. It's a fantastic strategy that's kind of universal. But the 5 expirations per week really make it special with the SPX and the NDX. So those are the best. Commissions on MES are not exactly efficient. All right. Well, Charles, are you just choosing all the worst possible things to trade? Yeah, I never trade the MES. Right? Why would you do that? That's like, why would you hit your big toe with a hammer? You can do it, but why would you do it? All right. That's enough of that. Yeah, poor Tesla lately. I agree, but now I think it's becoming a buying moment. Buy it from here all the way down. Just keep on buying. You'll probably 10x your money if you have the stomach to hold on to it for the volatility. All right, that's about it. I want to thank you all. Thank you very much. Again, if you like this content, give it a thumbs up, subscribe. We're here every Monday, Wednesday, and Friday with more lessons like this, talking about zero DTE. We are the zero DTE channel on the YouTubes and the internet. All right. Peace to you all. Have a great weekend. Take care. Music.